Welcome to Bunex Investment Group. In this video, we are going to go through these topics. The first one being why number of pips doesn't matter. Then the proof of why pips are not everything. And the last but not least, how to measure performance properly. So before we jump into the whole video, make sure you check out our free Telegram channel where we share free educational content as well as setups and trading advice. You may do so by using the link right in the description box below. On that note, let's actually continue with our content. So the first topic is why the number of pips doesn't matter. People ask me so many times over Telegram, over any other social media handle that we have, how many pips do you make per month? How many pips does a good trader make per month? And does your strategy make 100 pips a week? So these are all vague if I were to actually answer them. And in addition to that, there are so many Telegram channels that promise 1000 pips every month, and their performance report would look like this. They would say on the 1st of January, we traded GBP USD and we earned plus 200 pips. And on the 5th of January, we traded gold and we earned plus 456 pips. Let's be honest, a lot of signals channel on Telegram is how they report their performance. They actually give you a list of pairs against the pips that they would say they earned. Some of them will actually give you TP1, TP2, TP3, and everything that does that. Always know that they are there to take your money other than to actually give you proper thing. So here is the proof as we go. So here's the proof of why pips are not everything. The number of pips is probably the worst measurement of performance you can come up with. So someone will actually say this is debatable, and a lot of people, I understand, actually believe that the number of pips is everything and is all they need to see the performance of a particular trader. So it doesn't account for how much was risked to attain them. For example, please be with me on this particular example to understand this concept. Say we buy Euro USD with the following parameters. It's actually a signal that I have sent. Buy Euro USD at current market price. By current market price, we are just saying at the current price of signal release. So let's just say 1.345. That's just a random price that I've picked. Then the stop loss on that particular trade is going to be 15 pips and the take profit at 30 pips, right? And we are going to risk 1% of your account on this particular trade, and the risk to reward ratio is going to be 2:1. So by 1%, we are saying if you have a $1,000 account, right? If you have $1,000, we are going to be risking 1%, which is 15, which is actually 1% of 1,000 is actually $10, like that. So we are going to risk $10 on that particular trade. So what is our lot size will be the next story. So there are a lot of Forex calculators where you can input your balance and your stop loss in pips, and it can give you your stop loss, your lot size. So if this trade goes against us, we are going to lose 15 pips or risk lose 1%. So be with me as we go down with this example. So this trade moves in our direction and reaches our take profit. That is fine, right? It means we have made 30 pips, and since we risked 1%, we made 2%. I've said we were risking 1%, which is $10. So in this particular case, we have made $20, right? Then the next trade comes. It's buy GBP USD right now, and we all know that pound pairs are more volatile. Therefore, their stop loss might be a little bit bigger than other pairs. at current market price, and the stop loss on this particular trade is going to be 30 pips and the take profit at 60 pips. All right, and we are also going to risk 1% of our account. So by risking 1%, it's still $10 that we are risking. However, to do so, the lot size that we were using on Euro US is now going to be different on GBP USD. And as I've said, all Forex calculators available can help us calculate the perfect lot size such that when we lose, we will only lose 1% of our account, right? Then in this case, the trade goes against us and we lose 30 pips or 1%, as we have said earlier. So if we are to report our performance in terms of pips, like what other people or most Telegram channels does, we are going to have something like this. It's going to be buy Euro USD and we had plus 30 pips, buy GBP USD, it was minus 30 pips since the stop loss was hit, and the total was 0 pips. That is what you are going to see. But if you remember that we were risking 1% per trade, you would know that the above report is false. We have something on our account. So in terms of percentages, our report will be like Euro US hit our take profit, and on that particular trade we were risking 1% and expecting to gain 2%. This is what we gained. Then on buy on GBP USD, we were risking 1% and also expecting 2%. However, the trade went against us and we were hit. The total gain that we had, we made 1% on the overall account balance. Therefore, we made $10 on our $1,000 account. So to achieve this, it will require you to always calculate your lot size whenever you are trading a different instrument or different stop loss amount. This will give you a lot size to use such that the amount you lose is the same no matter the difference in pips of the stop loss, right? That actually brings us to the ARAM output or the ARA in Forex, right? What is the ARA in Forex? If you have been following our channel, our trading Telegram channel, you'd see that our reports will come as 5 ARA, 4 ARA, we have earned 2 ARA. This is what it means. So the ARA in trading is the amount we risk per trade. So let's say you have $1,000 and you risk 1% per trade. Your ARA is 1% or $10, which is 1% of $1,000. Therefore, ARAM output is a number that will tell us how many ARAs have we earned, right? So by ARAM output, we are now saying we have earned 2 ARA. If we say we have earned 2 ARA, we are now talking in form of professional trading performance, because the amount of risk is not always 1%. This trader risks 1%, that trader risks 2%. So if we get 2 ARA, right, we would know that a trader who risks 1% has 2 by 1%. And if another trader risks 2%, it's now 2 by 2, which means their gain is actually visible. So in the example that we were talking about, whereby we traded the Euro USD and the GBP we talked about earlier, our performance report would now look like this in terms of ARAM outputs. On Euro USD, our take profit was hit, and on that particular trade, we earned 2 ARA. Then on GBP USD, our trade actually went against us. Therefore, the total is now plus 1 ARA, which is plus 1 multiplied by the risk per trade that we are taking. So in conclusion, right, trading professionally does not boast with the number of pips. If ever you see people actually boasting with 10,000s of pips and a lot of pips, you'd know that they are not actually doing it professionally, but rather it boasts with ARAM outputs or percentage gain. So 1,000 pips on gold can be lucrative, but ask yourself, how much did we risk to attain them? And if we are going to take another trade on top of that, are we going to maintain our gain, right? Because if someone actually tells you that we have a trade hit our TP on card JPY, right? And our take profit was 60 pips, right? What is the amount or the number of pips on gold on your stop loss? Probably it's going to be 400 pips for us to gain 1000. Therefore, if a stop loss is hit on that gold trade, it means we are definitely going to be in loss side if we are measuring in terms of pips. But if we have the ARAs in mind, we would actually maintain our profitability and we would see that our account will have a consistent equity growth. So if you didn't know, if you didn't understand, the point of this video, repeat it. It's actually necessary to understand this concept in trading. You will definitely see change in your trading if you understand this concept. So from today onwards, don't just give people or pat the back of those who actually boast with pips. Know your stuff. That note, we come to the end of this video. Thank you for watching. Like and subscribe.